Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we continue with our EIS Basics series, and we're going to talk about tax release available on VCTs. As a reminder, as well as the audio podcast version, you can see the video version on YouTube. And today, I'm delighted to be joined by Paul Mattick, who is Head of Sales and Private Investor Relations at Mercia Asset Management. Welcome back to the podcast, Paul.
Hello, Brian. It seems a little bit strange to be talking about VCTs on the EIS podcast, but I can cover both. But it's great to be back. We've spoken many times before, but it's not recently, actually.
No, we had you way back on episode 25, I worked out, which makes it about 4 years ago. So it's great to have you back. So Mercia, do you want to tell us a bit about Mercia and why I asked you to talk about VC tax release?
Sure. So Mercia has been investing into tax efficient space since 2013, really. EIS, we were one of the first EISs have been in that market for 12 years now. And we came into the VCT market in 2019. So we manage the Northern VCTs, which are one of the longest and leading VCTs in the market. Hence, conversation with me about VCTs may seem a little bit strange because I'm probably better known for EIS. But Mercia and us and me know VCTs inside out as well. And, so happy to talk about either. One thing, it's EIS VCT, not BR though, so we don't do BR.
Okay. Well, we won't go into that topic because we can't even get the circuitous route today. So tax release on VCTs. I think the one that people mostly think about is the income tax relief. Do you want to tell us a little bit about what that is and how it works?
Yeah, so the easy way to think about VCT is it's 30% income tax, but the same as EIS, but actually it is treated a little bit differently in multiple different ways. So think about EIS fund versus a VCT fund. Yes, it's 30% income tax relief, but for VCT, it's only claimable in that current tax year. So when the shares are allotted, you can claim that 30% in that tax year. You can't carry it back as you can do with an EIS. In addition, this is one of the small nuances a lot of people don't get, is that the tax relief is based on the gross amount of VCT. So in most cases, so especially the established ones. So if you imagine put 100K into an EIS and you get the fees taken off and say, for simplicity, 10%, and you get 30% of 90K rather than 30% of 100K. And that sometimes surprises some EIS investors and advisors. But actually, with the VCT, any fees are taken. Yes, still the fees are there, but the income tax relief is based on the gross amount. So 100K in it's 30K of income tax relief. But say only applicable for that current tax year. So there is and this is due to the slightly different structure of an EIS and VCT. One is a specific fund, one is a portfolio of individual investments. So they are treated slightly differently. That nuance is often something we have to explain. And in some ways, I think it's quite important to be transparent about this, because there are situations where you imagine an advisor fee charging a very large advisor fee, so 5-10% even, you wouldn't actually see any change in the income tax relief. So that's the thing which we're quite careful about disclosing. But say the income tax relief is based off the gross amount, and the EIS is the net amount, effectively. So that is the main one for many people. But actually, we're seeing a progressive move towards focusing on dividends. Because
we'll come back to those in a minute. I just want to close a couple of things. So you mentioned sort of the 30%. There is a cap on that, I think, isn't there?
Yeah, there's 200K a year. So for amount of investment into a VCT, and it tends to be the minimums normally 3 or 6K. 6K is probably the average in the industry. Yeah, you can put 200K in, and the high net worths and ultra high net worths often just put 200K in a year, every year, creating a portfolio of VCT shares, which are paying out dividends, which we'll speak about later on. But you can layer up, and I'm sure we'll talk about the liquidity at some point, but I think that's probably something we'll come on to later on rather than at this stage.
And there's also a minimum holding time, isn't there?
Yep, 5 years, and that is more relevant for a VCT because you can actively sell it, but so your 5-year holding period has to be achieved before you can sell the shares to maintain the income tax relief. So yeah, it's similar but different than EIS in that EIS, you sell a company at a time. So if you have 10 companies, there'll be 10 different exits of the underlying portfolio companies, whereas a VCT, you can sell the shares back. So it's you sell the entire portfolio back at one point. So they are quite different at that time, but the 5 years is required, partly because it is a lower risk. There's more liquidity than EIS, so hence I think the whole longer holding period.
Yeah, and I think the other thing I might add is that, as you say, you can only take the VCT relief in the year that you invest, but a lot of VCT offers allow you to invest across the year the offer is in place and the following tax year. So we'll specifically say we'll let you do that if there's capacity.
Yeah, there are some VCTs that do that. I think most of certainly the large VCTs, they get sold out pretty quickly. We have seen some offers to like 40, 60 million pound offers being filled within days. I think that happens at the moment, but we certainly see, I think, a few months of some of the leading VCTs with long track records. But there is kind of two different kind of regimes of VCTs in terms of there's the ones that have been established for a long time, and there are some new entrants as well, which some ways they struggle to pay dividends, so they need different attractions. And but that's not going into too much detail. This is about tax, isn't it?
Yes. So you mentioned dividends, and I think that is the other thing that people are very interested in when it comes to VCTs. So do you want to tell us about sort of tax position on dividends?
Well, it's quite easy, and it's a bit different than EIS, and effectively it's a tax-free dividend. So there's no capital gains tax to pay. There's no income tax on it. So it means you effectively, if you get paid 5%, which is probably industry average per year, which is normally split across an interim and a final, then you get 5% into your bank account, which is great. Obviously, there's an option to reinvest as well, which again is a bit different than the EIS directly. So the tax-free element of the dividend is very interesting. You don't get that in most other situations. Obviously, it's wrapped in a pension or an ISA, fine. But most of the dividends coming into accounts are taxed and at whatever rates, and maybe marginal risk tax with dividend tax. So you can get quite a high effective rate of dividends. So like a 5% dividend if you consider the income tax relief and also the tax-free element, you would actually need to get about 12% from a normal stock to have the same cash in your account. So the gross equivalent yield on a VCT is actually really quite high, and we'll struggle to beat it from a standard non-wrapped stock. So that is quite interesting, and to mention something a bit broader, especially in the world of pensions coming back into IHT. So you think about annuities and creating an income in retirement, and these actually do look quite interesting. And I think that's probably part of the reason why we saw a bit of a surprisingly large VCT market last year. And I think that would probably be sustained and growing over the coming years. Yeah. But it's treating differently the dividends than EIS, where EIS, the dividends are taxed. VCT, they are not taxed.
It's maybe worth talking a little about dividend strategies and the payment strategies. You mentioned there's some sort of convergence across the market, but maybe you want to start with what Northern does and maybe talk a bit about what you see elsewhere across the market.
Sure. So dividends are very common in the VCT market, especially with the established managers. The younger managers, newer entrants, sort of struggle to pay dividends, but then normally after 3 or 4 years, they'll start paying dividends from their account. The strategy around it tends to be you pay an interim and a final, and on average would be around 5%, maybe 6, maybe 7% target, split across an interim and a final. And then following any big exits, which created a lot of cash within the VCT, there is the ability to pay special dividends. And we have seen special dividends being 10 or even 20% of the NAV of the VCT. That is unusual, but within the venture world, because obviously VCTs historically were MBOs as well as venture capital, and now we are firmly in the venture capital regime. You may see some really lumpy exits occasionally when some companies take off and become very valuable. So I think, so specials, I would probably say most VCTs can establish VCTs pay out maybe once every 5 years. And on an annual basis, it's probably between 5 and 7, maybe 8% that the VCTs are paying. So it does create a nice ongoing cash flow, and you can build. You're putting £200,000 in a year. Within 5 years, you've got £1 million paying out 50 to 100K of tax-free dividends per year. So it does look quite attractive. It does feel quite different to an EIS, which is interesting, seeing as it's often investing in exactly the same companies. So the wrapper is quite different. And despite both the investor and the underlying companies often being the same, which it's just strange to get your head around it, but that's just how it is.
How you say that is how it is. And it creates very different investment decisions for people about, how they choose. So I think the final relief I just want to mention is capital gains. And again, that's a very simple one.
Yeah, there are no capital gains tax. So again, it's the same as EIS, but I think it's more relevant in the EIS, where you may get some mega gains in a single company. You may get, say, 10 or 100x outcome on a single company within a portfolio, and that one is not taxed. Great. VCT tends to be less risky and also less high multiple return. And but within the portfolio of a VCT, the gains are not taxed. So it's a very tax efficient structure. So I think it's probably not as racy as EIS, but also not as generous on the tax side. So there's no IHT, there's no CGT deferrals. So it's kind of almost, I tend to put it, if you're putting your toe into the water of venture capital with the VCT, rather than EIS, where it's proper venture capital, but you've got some fantastic tax relief to support it.
Yes, that's a very good summary, I think. So if anyone wants to find out more about what you're doing at Mercia, where should they go?
Yeah, our website's the easiest place, mercia.co.uk. And we've got specific EIS and VCT pages, and we're one of the larger investors in the markets, private assets and EIS VCT. So we'll raise and deploy, I think we deployed 200 million last year across the group, and we'll probably raise like 70, 80 million across tax products this year. So we are one of the leading people in the market, and happy to talk to anyone about what we do.
Excellent. Well, hopefully some people will see this and get in touch. Thank you very much for coming on the podcast again, Paul, and talking about tax relief.
No problem.
As usual, you can get full show notes with links at harmanandco.com/podcast. You can subscribe to the podcast on all good podcast services and players, or through the link in the show notes. If you like what you hear, then please tell a friend or a colleague, or give us a review on your favorite podcast app. We can be contacted at inquiries@harmanandco.com. Thank you for listening, and we'll be back next week talking about SEIS.